How do you evaluate a portfolio? Is it a good portfolio for you or a bad one for you? One of the most common mistakes people make is they'll look at it over, say, a 3-month period and they'll say, well, this is below what perhaps the index is, or below another set of stocks I could have bought. There's several problems with this approach. First of all, it does not take into account the time frame. 3 months over a 12-month holding period is too short a period to examine the portfolio. Secondly, it doesn't look at the fact that over such a short period of time, yes, a random selection of stocks may luckily have been in exactly the sectors that the market was chasing. But for the future, trying to predict those sectors, which you may well have got by chance to begin with, is not something which is replicable. So we're going to look at what is replicable, because that's what needs to be done in our portfolio selection to begin with. So there's chance, which can fool you. Fooled by randomness is a common problem. Similarly, the index may well have risen over that period, but your stocks were only lagging because in that 3-month period, there'd been some profit taking because there'd been such good stocks, they'd risen so much, and they will resume back upwards and outperform the index. Now, that's where we're looking at quality. So let's look at those two factors, quality and also that ability to be resilient as a stock. So how do we find quality? Well, we do want to look at the profitability of a company relative to its share price. We do want to look at sales growth, cash flow. We want to look at its consistency of outperforming the market. It won't necessarily outperform it every second, every minute, every day, or every month of every year. But overall, over a 12-month period, yes, it does tend to. We don't have a perfect crystal ball. So it's a question of what does it tend to do? Okay. And also, is it outperforming, or whatever performance it's generating on average, has it done that with very little volatility? In other words, its rewards, the performance is strong compared to volatility or risk of missing that. Put it in mathematical terms, the average return is high compared to the standard deviation around it. Those are all the factors which will give us some degree of resilience and also some degree of assurance that should the market have fallen in the short term and the stock's been punished more because they bagged all these profits, which people wanted to get out of, it's more likely to rebound more. And we've got to give it 12 months, I'm afraid, to do that. We're not trying to pick stocks which every day will outperform every index and every random selection of stocks over which you might have got lucky in the short term. That's why we're not in the crystal ball business. We're in the resilience business and the quality stocks business instead. Good luck.